Nick Forsyth here. As many of you may know, Market Matters has real money in the market, and the thoughts that we come up with on a daily basis and the stocks we talk about are actual stocks that we are transacting with in our own portfolio. Now, with the 8-year bull market in US markets drawing to a close, we feel it is imperative to provide an update to investors which talks about our processes and our strategies within the market to show people that there is actual method to what we do on a daily basis. Over the next few weeks, James and I will be providing a series of videos which talks about what we think matters in the market when managing our portfolio. James, welcome.
Thanks, Nick.
James, although we're not traders, we do try and stay nimble. One thing that has really worked for us over the years is knowing what sectors to buy and knowing what sectors to avoid at certain times in the market. Now, could you elaborate further on that for everyone watching?
Yeah, you made some good points there, Nick. So we're certainly not the norm. So the approach that we take to markets is a little bit different. So it needs some explanation. There's some really good examples over the last few years around when to avoid sectors and when to be involved in sectors.
So you've touched on sector rotation, James. What do you think sector rotation is in a nutshell?
So I think there's broader economic factors that impact the headwinds or tailwinds for individual businesses or companies. So if you think about interest rate sensitive stocks, so things like Transurban, Sydney Airports, etc., stocks that hold a high amount of debt in a falling interest rate environment, they obviously benefit. Their earnings benefit. As interest rates start to rise, it's obviously a headwind to their earnings. Insurance stocks benefit from interest rates going up rather than going down. So, from a positioning point of view, you just got to be a little bit, respectful of the underlying economic conditions that are playing into a company's performance, and position portfolios accordingly. So that to me is what sector rotation. Not all sectors have similar, push and pull factors, if you like.
James, I'd have to say a great example of that was probably last year in November, moving into the insurance space, in particular QBE, and more recently buying some of the miners. Can you step the investors through the thought process in buying those two positions?
Yeah, when we bought QBE, everyone hated it. So there was a lot of negativity towards QBE, because global interest rates were really low, which impacts their earnings, and B, because insurance premiums were still in decline. But those two trends were starting to change. So, as I've said previously, markets price the future 6 months down the track. So if you've got the expectation of those two underlying trends changing, then you go and buy QBE. We bought it around $10. We're sitting in a nice, 20% profit from here, but we'll continue to hold that because we think those trends have got further to play out. You made mention of resource stocks.
Yep.
So, global growth is continuing to accelerate. Even though it's going to be fits and starts and there's going to be positive and negative short-term economic indicators, the longer-term trends remain positive for the next 6 to 12 months. So we'll stay, in our resource positions for the moment. So it's all around when you enter something and not naturally pricing the here and now, but looking 6 to 12 months down the track.
Okay. James, all the stuff you're saying is all well and good. But has it boiled down to better performance over the last 12 months in what's been a testing market?
It has been a testing market, there's no doubt about that. But yeah, it certainly has. I mean, if you go back from 1 January 2016 to where we are now, the ASX 200's up around 6%. So, our portfolios are up around mid-teens over that period. So that's a reasonable amount of outperformance. And you get that by being a little bit more active, being in the right sectors at the right time. And that's what we really concentrate on.
Okay, James. I guess the beautiful thing about the market is there's always something happening. Now, at this current point in time, looking out 6 months, is there anything on your radar that you're looking to buy or may have just bought with a 6 month time horizon for everyone out there watching that may not be a member?
From a macro standpoint, I think the biggest thing at the moment is around the US dollar. So we've called it in recent times that the US dollar is, the next big move will be down in the US dollar, even though interest rates are being raised. And we say that because the trajectory of interest rate hikes is probably not going to be to the level that the market's anticipating. So the Fed's now guiding to 2 more rate hikes. The market was positioned for 3. So, that to us suggests downside for the US dollar. That has implications for sectors on the market. If you're looking for one thing, we just bought primary healthcare yesterday. We think that's a reasonable shorter term position up to $4. Bought it in the lower $3 level. And some of the banks rotating around for the dividends. And they benefit as rates go higher as well.
And that lower US dollar theme is, is that something for gold, maybe?
Yeah, it's supportive for gold, and it's also supportive of other commodities. So it's a reason why we'll stay, the course on gold. We've got Regis and Evolution in our portfolio. We like it. We've bought them at lower levels. But again, if we've got the expectation of the US dollar going lower, then we'll continue to hold those positions.
Fantastic, James. Thanks for the insights. And thanks everyone for watching. And keep your eyes peeled for some more videos over the coming weeks.